Thanks for tuning into Talking Point. I'm your host, Neeraj Shah. We've got the Citi think tank here to talk about, well, as a premise to talk about what the earnings have been for Q4 and FY24, but really, it's more about what could happen over the course of the next 12 months, because between the time that the earnings ended and now, a lot of water has flown under the bridge. So the gentleman, Surendra Goyal, Head of India Research at Citi, Kunal Shah, Director of India Banks Financials, Arvind Sharma, Director India Autos and Transportation, and Saurabh Handa, Director of India Oil and Gas and Telecom, with me in the studios. Wow, I wonder how will I complete the conversation in 25 minutes allocated time, because all sectors just so important. But gentlemen, thank you so much, all of you, for joining today. It's a real pleasure having you. Surendra, starting off, earnings, policy up ahead, but most importantly, the events over the last 3 days. Have they changed your outlook as on the India strategy from what it was last Friday to what it is maybe today?
Yeah. So first of all, thanks for having us here. So let me go point by point. See, firstly, from an earnings perspective, the outcome was pretty decent, right? And there were a lot of moving parts in terms of some sectors having one-offs and so on. But I think the most important thing was, if you look at the Nifty earnings revision for consensus, the direction is up. Okay, which is what kind of summarizes the view. So earnings, I would say, at the margin was overall positive. The trends are quite supportive. We saw the recent GDP data come out, which was again better than what most people expected. So I think on that side, there is comfort that things are kind of progressing in the right direction. From a election perspective, obviously, still we have to see a lot of things happening as we speak. But overall, I think a few things. Firstly, from a macro standpoint, I think there was the RBI dividend news which came in between, right? So clearly there is a lot of cushion right now. So our view is that even with slightly increased spending on rural jobs, etc., there is no real need to dial back or step down on capex, infra, which the government has been doing. So there is space for that. So our view still remains that the focus on capex and infra will remain. Okay, I think in the near term, increased risk perception, there'll be a lot of noise, news flow, so the market will keep on reacting. In fact, if you look at yesterday evening when we were talking to clients, we were telling them that yesterday's Nifty close was more or less the same as Friday's Nifty close, right? But in between, there was a lot of volatility. So I think you could see that continue. Depending on the news flow and noise, the market could move up and down. But assuming that things kind of progress in the right direction, the broader story, right, which is premised around a few things: India's superior growth prospects, strong domestic flows argument, and a great macro, a top-down from an India perspective. Those are three things which are all supportive. So to that extent, I still think it's a fairly decent backdrop. And from a sectoral perspective, at this point, we have not really changed much. I think at the margin, the sector which should see some benefit is the rural side, which is consumer staples and autos. So that's the only incremental one. Otherwise, I think broadly we are comfortable with wherever we are positioned.
That's interesting, because autos have done really well thus far, while staples may have not. So I was going to ask you in portfolio rejig. So does this come at the expense of maybe some of the capex beneficiaries or some of the others? I mean, when these two sectors move slightly above? Yeah.
So again, the point I made on capex beneficiaries, etc., the names that we have in our preferred list, we are quite comfortable with the medium-term outlook. Okay. And for us, I think, as I said, we are not expecting anything to slow down on the capex side. We still think that that's something which has been happening for a while, and the direction remains the same, it's unchanged. And some of those stocks which are a play on that, where there is a very good medium-term visibility, they continue to do well. Okay, so I think people will really need to wait and watch, because some of the stocks which are play on rural have also moved up 15% in the last couple of days, right? So a lot has gotten priced in also. So I think now, if you look at from a data point perspective, first, possibly minimum support price announcement, some point end of June, early July, then the budget. I think people will want to watch out for what happens, okay, because some of this already got priced in very rapidly in the last couple of days.
Fair call. I'm starting off with the topical piece first and then moving on to the other things. One of the things that happened overnight, and therefore oil and gas comes firmly into play, right, Saurabh, is this whole thing around PNGRB doing this. Plus, but beyond that, we're seeing oil prices being very, very contained. Now, to the regulatory piece secondly, but first, by virtue of the fact that oil prices have come off so much, how does that, if at all, change the picture or the outlook towards different components within this space?
Right. So firstly, in terms of if you look at the downstream oil marketing companies, and if you look, say, a month back when oil was close to the late 80s or $90, there was this concern that these companies are now losing money on fuel pricing, that's petrol, diesel. And there was a general view that maybe after elections, if there is no major surprise, these guys can come and take a price hike. Now, maybe a petrol diesel price hike at this point of time is unlikely, but it's now not even needed. So in a way, we've, since the OPEC events, etc., oil prices have come off. They're now at a fairly comfortable level in the late 70s, which is quite comfortable from the marketing margin for petrol and diesel. So I think if oil continues to remain in this range, which is CITI's commodities view, our global view, say it's in the mid to late 70s, then that's pretty comfortable for the oil marketing companies. So we retain our constructive stance there. The stocks that we like there are BPCL and HPCL, so we have a buy there. I think the market may still await some bit of political clarity, some sort of clarity on policy on some of these stocks, because ultimately they do fall under the quote-unquote PSU category. And petrol, diesel, fuel pricing, we know, is generally politically sensitive. So maybe the market might adopt a slightly more, pragmatic approach towards some of these. But on the gas side, where things are not so politically sensitive, and since you alluded to that, we are a lot more constructive. So we like stocks like GAIL, city gas names like IGL, MGL. So, there is, now that the elections are done, the NDA actually has a majority in the GST Council. So maybe petrol, diesel are a lot more difficult to bring under GST, but gas is clearly possible. We think it can happen. Timelines are always very difficult to judge, obviously. But the whole value chain benefits, the government has this target of increasing gas usage in the economy. And if they do manage to pull this off, then stocks like GAIL and some of the gas distributors should benefit. There are also some moves around on the regulatory side, which in our view works in favor of some of these stocks. So overall, our constructive view on the gas space remains intact.
So some moves which may come, but based on what you've heard thus far, and if indeed the GST Council moves, you think GAIL is a principal beneficiary, or GAIL plus the city gas distributors kind of on earnings basis, if such a thing would happen, would be equal beneficiaries?
Yeah, so in our view, GAIL actually has a direct earnings benefit because there are certain stranded taxes for GAIL because they use gas internally, and those may be stranded taxes. They may be able to, now get the tax credit. Whereas for the gas distributors, it could be a direct earnings benefit, or it could be indirect in terms of, general more gas usage in the economy, which helps their volumes. So our pecking order is GAIL and then the gas distributors like IGL, MGL, but these are our three main buys in the space.
Got it. I'm going to come back to you on Telecom as well, by the way. So that's the other interesting piece. Just, Kunal, the other aspect is banks. For 4 years on a trot, we've been arguing this on television, and no right answer here, but just want to get your view. At least no right answers as our end, so therefore getting your view is important. For 4 years on a trot, PSU banks outperformed the private banks by a distance, YTD too, despite the falls of Tuesday by a country mile. Does that change now, or because the fear was on Tuesday that maybe PSUs take a back seat and the others come to the fore, and valuations were also reasonably good. Do you sense that to happen naturally as well, or does a continuation of Modi 3.0 mean that it's not necessary that PSU banks will derate?
So as was highlighted by Surendra with respect to the expectations which have been there on infra and capex, maybe we still expect that it will be on the budgeted lines. There might not be too much of a positive surprise which can come in, and a lot of expectations were getting built into the PSU's growth trajectory, maybe on anticipation of better than anticipated capex. So that I think those expectations are now very much on the expected lines and not maybe on any kind of a positive surprise. And second, in terms of the cyclicality with respect to the benefit of recoveries which flow into the overall ROA trajectory, that was reflected in 4Q as well, and that has supported ROAs upwards of 1% for most of the PSU banks as such. We need to see as to how far can it sustain. The guidance from the management has been maybe it might continue for another 2-3 quarters or so, but maybe thereafter it will be the core earnings which will really play out for them. And then we need to see as to where we are seeing the positive surprises on the ROA trajectory. While on private, when we look at it in terms of the earnings delivery, this time also there was, so there were like two key metrics which were being looked upon. One was with respect to margins and second was with respect to the deposit growth. And in fact, when we look at it, most of them surprised positively. So across the board, margins have settled higher. The exit quarter margins were higher than what the entire street was building in. As well as deposit growth, there was a huge catch up. Initially, it was thought that it will be more back-ended. But when we look at the fortnightly data, in the first fortnight, it ran down. But again, there was the uptick in the another 2 fortnight. And when we look at it since March, it's hardly down 1% odd.
Right.
Okay, so it's not much in terms of the maybe the rundown in the deposits which has happened in 1Q, which builds the case that at least on the deposit growth side, the momentum can still continue. And this will support the overall loan growth as well. No doubt there could be a moderation of couple of percentage points at the industry level. That is what we are also building in. But otherwise, maybe it should be very much in line and no disappointment out there.
So are you net, I mean, are you more constructive with private banks than what you would have been, say, 6 months ago or 9 months ago versus PSU banks? I mean, I'm not saying you were constructive with PSU banks, maybe one odd, if at all. I'm just trying to understand, does the narrative change now or is it still, is it present continuous?
So we believe like private, we still continue to be constructive, and in fact, for the first time, we started to see the operating efficiency also playing out in one of the banks, which was ICICI, and if we are able to see that over next 2-4 quarters, I think the case can really be made up in terms of like the sustenance of the ROA profile, which we have been highlighting that will be the key to re-rating for the private banks, and I think that visibility is just improving.
Got it. Okay. Now, just before I come to autos, but just have to dwell on this one point wherein, Surendra, I want you also to come in. Almost, this is the common question being asked for this stock every single time, right? HDFC Bank. It's almost become an ITC meme of 2 years ago that when will HDFC Bank move? When FIs come in? When will FIs come in? Very difficult to say that. So dwell in on this, both of you. I mean, is a lot of private sector banking moves dependent on when foreign flows come in? And if so, when do foreign flows come in?
So I'll just touch upon the fundamental aspects first and then on to the flow side. So when you look at HDFC, again, Q4, their margins against the expectation of a decline, there was an improvement. I think still that kind of a confidence is not there in terms of how much of that can sustain in 1Q. And if we still see both deposits as well as margins holding on in 1Q, that will give much more confidence and improve the visibility on the core ROA profile for HDFC, which I think may drive the flows into the name as well, and maybe on the FI side, Surendra can take that up.
Yeah, so let me comment on the private banks rather than commenting on one stock.
Yeah, not one stock, yeah, of course.
So I think a few things to keep in mind. Firstly, we track AUM of around roughly 400-500 billion on the EM side on a monthly basis to see how their portfolios are moving. And there, after a long time, we are seeing India as an underweight.
As an underweight?
Yeah, so India is now approximately 100 basis points underweight in those EM portfolios, and we use it kind of a proxy for the overall EM space. And this is like after at least a decade. Okay, in that period, they have always been overweight. Of course, India's weightage in the index has obviously gone up in the last 4-5 years. So that's point one. Secondly, I think if you see, we have already seen significant outflows this calendar year. So right now, positioning is relatively light on India from underweight perspective. Secondly, if you look at the market multiple, and we were just looking at it at the start of the day today, we are at 19 times 1 year forward earnings, which is exactly the 5-year average multiple. Okay, so I think people get comfortable that, yeah, and obviously people, before an event, people typically always kind of become a little careful, let the event get over and so on. So I think we are getting to a point, and again, also there have been EM outflows. So there are multiple things going on, but overall construct with that underweight position is a lot better, right? If you start seeing EM flows improve and India growth outlook continues to be superior, there is a case to be made for some of that to reverse. So I think those are the factors we are really watching out for. And yes, if those flows come in, it will benefit private sector banks. Having said that, I still think it's not only contingent on private sector banks.
Yeah.
If you see growth improving, right, the fundamentals improving where there have been some question marks in the past few months, you could even see domestics kind of stepping up and adding those stocks. Because on a valuation basis, there are not that many large pockets in the market today where valuations look very reasonable in the historical context. Okay, so private sector banks is one of those very few pockets. So I think you get some conviction on earnings. It becomes attractive for everybody. EM inflows happen, upside.
Now, Surendra Goyal mentioned that one of the things, or two of the things that make a bit of a slightly higher weightage on the portfolios might be FMCG and autos. We all discussed FMCG to death in the last 24 hours or 48 hours. Let me bring in Arvind into the conversation and try and talk about autos. Now, autos, I thought, didn't need a bit of a leg up because the earnings growth the last 3-4 years has been, I believe, selectively very, very good. Monthly data looks okay. What's your sense about how would you advise your clients to approach auto now over the course of the next 12 to 24 months?
Sure. So, quick recap on the earnings. I think most of the companies kind of surprised positively on the earnings. Of course, we get the volumes every month, but even the margins were kind of good. Also, what was encouraging was the commentary from most management was positive after a long time. Earlier it was more of cautious optimism, but now a lot of them were positive, especially in rural. Now, going forward, rural and consumption stocks and companies could benefit from volume growth. Naturally, there's a base effect. So, in passenger vehicles, the base is a little higher. So, your YOY growth might be slightly on the lower end. In two-wheelers, we are yet to reach the peak. So, YOY growth would be better optically. If there's a growth in rural areas, then we could see some of the more rural-focused names, entry-level two-wheelers, tractors, of course, passenger vehicles. Those would benefit significantly from a growth in broader consumption. Now, autos kind of straddles between capex-oriented stocks and consumption-oriented stocks. So, if the capex infra also continues, we could see positive trends in the more capex-oriented stocks, commercial vehicle manufacturers, right, and the allied vendors. So, all in all, most companies going forward, the volume outlook looks good. They should benefit from the operating leverage. Over the last at least 2 years, 1.5 years, the commodity prices have been a bit benign and all of them benefited. But now, at least in the last conference calls, most management said that it's not a cause of worry, but there is some inching up in specific commodities, which we'll have to see. If there's a good demand, they could take up prices, they could cut on discounts. So probably a good demand could offset those cost pressures. So essentially, we see most of the domestic-oriented auto companies doing well going ahead.
Okay, and I'm just trying to understand what's the top of the pecking order. Is it the rural-focused themes, two-wheelers, tractors, etc., or is it maybe the capex beneficiaries that form the top list?
So, if you see all the rural-focused names, starting with the tractor manufacturer, Mahindra, in the two-wheelers, Hero Motocorp is the most exposed to rural, and in passenger vehicles, it's Maruti, which is almost 35 to 40% of rural. We are constructive on all the three names. Maruti is our top pick. Going ahead, if you see the broader two-wheeler industry, I'm talking only about the domestic part, could see an uptick. So some of the vendors might also be a good play. You kind of isolate yourself from the market share fluctuations, right, play on the broader industry. So that's how our pecking order is. We are constructive on the commercial vehicle maker, which is Ashok Leyland 2. Specifically to that, even the bus segment demand has been rising quite a bit. And going forward, if there's a bit of pent-up demand among the state transport undertakings, about the orders which have not been placed over, say, past 6 months, and they come through, you could see a growth in the bus demand. And that is a highly profitable segment.
Got it.
So I think from commercial vehicle manufacturers, it's both capex and bus which helps them.
Time permitting, I would love to know about some of the vendors as well, because it's such a large bucket now. But I just have to cover time for 2 more sectors, so I want to just quickly go that. Before I come to IT, a word on telecom, cannot not talk about that. Come in here, it's now firmly a 3-player market in the minds of a lot of people. From an investor's perspective, does it become a 3-option telecom market, or maybe if I include Indus, then 4, or not quite?
Yeah, no, I agree. So, I mean, the successful fundraise of Vodafone Idea clearly, I think, ensures that they can reinvest in the business and, catch up on network investment, something which they were lagging on over the last few years. So it's clearly, pretty much a 3-player market for now. It also appears from statements made by the government that even they are fairly keen that competition remains, and they're fairly keen that this industry structure stays intact. Yeah. So we are still potentially looking at tariff repair happening. Maybe some expectations may or may not be toned down depending on events of this week, but our view is maybe a 15% tariff hike potentially still happens.
Sometime this year?
Sometime this year, yes. So, so that's one. There are also, this whole AGR case is still pending in the Supreme Court. So that's something which we need to watch if there can be any positive developments there. Still not our base case as yet, but it's something to monitor. Bharti remains our topic in the space, but we are also very positive on Indus Towers. It is a good proxy play on, the industry structure, improving and becoming a 3-player market. So these would be our 2 preferred plays. And in Vodafone Idea, I mean, clearly things are a lot better now, but a lot more still needs to fall into place. So we think Vodafone Idea is more like a show me story. So they need to now deliver in terms of the capex execution, and then, sort of maintaining or stabilizing their market share. And as I said, the other big things to watch out for will be what happens on the tariff side.
Got it. Well, certainly watching out for that. Bills that we pay also get dependent on that. Surendra, one final thing. We're talking about banks being that large bucket. IT is the other one. If I remember the January note, I haven't seen the last one, but the January note, you were not constructive. The commentary hasn't really changed to my mind. Has it changed in your mind? Are you changing the stance?
Sure. So before that, let me just clarify that the comment that I made on autos and staples was about investors would think about it at the margin. We have not really changed our stance. We are still overweight on autos and neutral on staples in our last published note. So no change in stance, but that's how we are positioned. Now on the IT side, we are still cautious. We haven't changed our stance for around 2.5 years now. So still cautious. See, there are quite a few things in play on the auto side. Firstly, people attribute a lot of the challenges to just the macro uncertainty in the US. We think it's more than that. And we have looked at a few things which kind of suggest that. If you look at the global software companies, there have been disappointments there also, but the year-over-year trends there have improved, right? If you look at the last 4 or 5 quarters, they have been on an improving trajectory. If you look at the hyperscalers or the cloud companies, even their growth rate bottomed out a couple of quarters back and they started improving. While services, and not only Indian IT, when we look at our global IT services coverage, the growth has been challenged. So we think there are quite a few things at play beyond the macro uncertainty. One is the whole GCC theme, which I think a lot of people have spoken about. The other thing we are starting to see is as clients prioritize the incremental spending towards AI, some of the other areas of investment are seeing some negative impact. And to that extent, unless somebody is heavily exposed to AI, which the IT services industry at this stage is not, you may end up losing a little bit. So I think there are multiple things going on. There are headwinds, and which is why we still remain cautious on IT services.
Well, on one, maybe a bit of a hope for FIs. The second one, if they're listening to Surendra Goyal, they're not putting in money in a hurry for sure. Gentlemen, all of you are out of time, but thank you so much. It was lovely, very insightful. Thanks for taking the time out and giving us your thoughts. As always, as every quarter, really appreciate your time.
Thank you.
Thank you.
And viewers, thanks for tuning in to this wonderful edition of The Talking Point.